At the beginning of this chart, we can see that the market is clearly in a bearish trend. The price keeps forming a series of lower highs and lower lows, often marked as LH and LL on the chart. This is a classic sign of bearish momentum, showing that sellers are in control. Each time the market pulls back, it fails to break the previous high and instead continues lower, creating new lows in the process. This structure of consistently lower highs and lower lows defines a strong downtrend. Now, look closely at the middle part of the chart. Here, something interesting begins to happen. The price forms another lower high, but this time, instead of continuing downward, it breaks above the previous lower high. This is the first early sign that the market structure might be changing. When the price breaks a previous lower high, it tells us that buyers are starting to gain strength and sellers are losing control. It's an early hint that the downtrend could be coming to an end. After this break of structure, we don't immediately assume the market has reversed. The next step is to wait and see if the price respects the last formed low and begins to create a new higher low. This is a key confirmation step in market structure analysis. If the price manages to hold above that low and then pushes higher to make a higher high, it confirms that the trend has now shifted from bearish to bullish. And that's exactly what happens here. The chart shows the formation of a higher low, followed by a higher high. This new structure, higher highs and higher lows, signals a clear bullish market structure. It means that buyers are now in control, and the overall direction of the market has flipped from downward to upward. From this point onward, the price continues to make higher highs and higher lows, confirming a strong bullish momentum. Each retracement finds support at a higher level, showing that buyers are stepping in earlier and driving the market higher every time. This behavior visually marks the transition from a bearish phase to a bullish trend. After understanding how market structure shifts from bearish to bullish, the next important concept to grasp is how to trade within ranging zones, areas where price is not strongly trending in either direction. In this part of the chart, we can clearly see that the market enters a phase of consolidation between two major levels, the main resistance zone at the top and the main support zone at the bottom. This area is what we call a range, where price moves sideways, bouncing between support and resistance instead of forming clear higher highs or lower lows. Now, many traders make the mistake of thinking that trading a ranging market is easy, but in reality, it requires discipline and patience. Inside this range, you can see multiple touches on both the resistance and support zones, but none of them lead to a breakout right away. The key here is to identify a clear traffic zone where price tends to move smoothly from one level to the other without too much consolidation. This zone helps traders find potential entry and exit points with better risk-to-reward setups. If you look closely at the chart, you'll notice how the market forms several new lows near the support zone. This shows that sellers are testing the bottom area, but the price continues to hold strong, indicating that buyers are still active at this level. On the other hand, every time the price reaches the upper resistance area, it faces rejection, confirming that sellers are defending that zone. This constant back-and-forth movement defines the ranging phase of the market. Eventually, we see a clear break and retest above the main resistance zone. This moment is crucial. A breakout followed by a successful retest is often the signal that the range is ending and a new trend is beginning. Traders who wait patiently for this confirmation can catch the move early, entering trades with a stronger probability of success. In this case, once the retest is confirmed, the price accelerates upward, breaking out of the range and moving cleanly through the clear traffic zone, offering a high-quality buying opportunity. This setup also demonstrates an important trading principle. Patience leads to precision. Instead of guessing whether the market will break up or down, professional traders wait for the structure to confirm. The ideal trade forms when the price breaks through resistance or support, retests that level, and shows momentum in the breakout direction. This kind of setup provides a clear entry signal, a defined stop-loss level, and a logical take-profit zone, in this case marked as the resistance zone or target profit level at the top of the range. Technical analysis annotations. The chart depicts a potentially bullish reversal scenario building after a prior downtrend. The analysis identifies a 2x bottom pattern, signaling that the price has tested a support level twice and held, indicating that selling pressure is waning at those lows. This is further supported by the formation of two new higher lows, which confirms a strengthening uptrend structure by establishing successively higher low points, ensuring that the most recent low is higher than the overall previous ones. The bullish case is strengthened by a key breakout where the price broke the minor resistance, and this move was accompanied by a specific candle that showed bullish pressure, suggesting strong buying momentum. The immediate market objective is now to rise and fill a nearby imbalance in the market profile, with a final target level identified beyond that. Throughout this price action, the Relative Strength Index, RSI, is being monitored, likely to confirm that the momentum is bullish without being overbought, adding confluence to the overall positive outlook. This second chart introduces the Commodity Channel Index, CCI indicator, which is being used alongside the RSI and price action from the previous analysis to provide a more comprehensive trading picture. The text explains that the CCI's primary function is to spot trend changes. It does this by measuring how far the current price has deviated from its statistical average, helping to identify when an asset is potentially overbought or oversold relative to its established trend. The chart is divided into distinct upward and downward zones, which likely correspond to key CCI threshold levels, typically WAJ 100 and 100. A move from the downward zone into the upward zone would generate a bullish signal, adding confluence to the bullish price action, 2x bottom, breaking resistance, and RSI analysis from the previous chart. The chart is conceptually divided into two key areas, a downward zone and an upward zone. These zones correspond to standard CCI threshold levels. When the CCI line is in the downward zone, typically below a key level like 0 or 100, it suggests the asset is in a bearish or negative momentum phase. Conversely, when the CCI line moves into the upward zone, typically above 0 or 100, it signals a shift to bullish or positive momentum, indicating a potential buying opportunity or a confirmed trend change. The analysis highlights a resistance zone on the price chart, which is a critical level where selling pressure has previously emerged, causing the price to decline. The chart also points out the overbought zone on the RSI indicator, which is typically a level above 70. This zone signals that the asset may be overbought and due for a potential pullback or reversal. The combined message is crucial for risk management. While the previous charts established a bullish outlook, with breakouts and CCI turning positive, this chart cautions that the price is now approaching a significant resistance zone. Furthermore, if the RSI enters its overbought zone at the same time, it would reinforce the possibility of a stall or rejection at this level. A trader would watch to see if the price can break through this resistance with strength, or if the overbought RSI condition leads to a pullback. The sequence begins with a strong upward, massive move, which is then followed by a period of consolidation labeled distribution. During this phase, the price action shows signs of the trend weakening. It makes a HH, higher high, but this is followed by a double top pattern, which is a classic reversal signal indicating that buyers are failing to push the price to new highs. Another HH attempt occurs, but it is again met with distribution, confirming selling pressure at these high levels. The trend then definitively breaks when the price creates a HL, lower low, breaking the pattern of consistently higher lows. This breakdown triggers a breakout to the downside. The annotation HLL plus likely signifies a lower high and lower low, confirming the new downtrend. This final breakout marks the completion of the distribution and the start of a new declining trend.